The stock market is crashing, and instead of buying individual stocks like Amazon and Tesla and Microsoft, you should be investing into a big basket of stocks. There are two ETFs, which are exchange-traded funds, which track multiple stocks at a time, which helps you to diversify your portfolio and invest better for the long term. And these two funds are VOO and VUG. And these two funds allow you to get better returns with taking less risk than investing into one specific stock. In today's video, we're going to be describing why you should be investing into these two funds, what the difference is, and why you should not be just investing into your normal 2060, 2065, or 2070 retirement plan. So let's discuss the two, all right? So to start it off, we have to take a look at the overall returns over the past 10 years. VOO tracks the overall S&P 500. So it takes the S&P 500, which is a list of the top 500 companies in the US stock exchange, and puts them all into one basket and diversifies them based on different percents and how they return. And you can see here that our top 10 list is pretty strong, well-relative names that we all know and love within the stock market. And the VOO overall over the past 10 years has annualized a return of approximately 12.69%. Now, taking a look at VUG, which has annualized a return of approximately 14%, it's a little more tech heavy and follows more of the tech type stocks, but again is diversified among many different stocks among the stock market. Here are the top 10 holdings of those as well. Now, taking a look at something like a Vanguard Target Retirement Fund, let's throw out a 2065 retirement fund. The past 10 years, this has annualized a return of approximately 6.94%, which is relatively lower than the other two. Now, you may be asking yourself, all right, well then, why is it that anytime I open up a retirement account, they automatically want me to open up a 2050, 2060, 2070 retirement account? Well, because it's easier that way. A lot of these companies like Vanguard want you to just invest into that because there's no risk involved. You make your 6, 7, 8% per year, and that's that. But something interesting you should look at that not many people follow is the expense ratio. And taking a look at that, VOO has an expense ratio of 0.03%. So this expense ratio basically looks like this. If you invest $1,000 into VOO at a 0.03% ratio of expense, it's roughly 30 cents. But slowly over time, that amount adds up. $1,000 is 30 cents, $10,000 is $3, so on and so forth. With VUG, it's 0.04%, not much of a difference. Now, our Vanguard Target Retirement Fund of 2060, 2050, 2070, whatever it is, has an expense ratio of 0.08. Now, not that that's much of a difference in the short term because it's only 80 cents of an expense ratio if you invest $1,000. But you take that money and you invest tens of thousands and hundreds of thousands of dollars, that fee slowly adds up if you invest into 5 or 10 different ETFs and over time invest tens of thousands of dollars into those, you're looking at hundreds of dollars in potential fees. Now, that 0.03% makes a big difference between 0.03 and 0.08 looking long term. Now, if we reverse back to look at VOO and VUG at 0.03 and 0.04 expense ratio and the returns of 12 to 14%, that is a much better margin than paying 0.08% expense ratio for a annualized 6.9% in your overall retirement account. Now, taking a look at the stock VOO, you can see that overall, yes, this is a minor pullback in the grand scheme of things. Looking back, you can see from basically the start of 2023 throughout 2024 and into 2025, we have had the strongest returns we have seen overall in the S&P 500 and overall in the stock market in quite a while. We have been in an upward direction following this red SMA line, and this pullback has been great because it's given us opportunities to invest and buy on the dip. And this is a great buy the dip opportunity. You guys are missing out if you're not buying the dip, and if you're not retiring in the next 3 to 5 years, then why are you stressing? Why are you worried? Because you really should not be. This is a amazing opportunity for you to invest into great long-term names and great long-term mutual funds and ETFs that in 10 to 15 years from now, you're going to be looking back like thanking yourself that you invested and bought on the dip. Because yes, in the short term, it may not be great. And we may dip even lower. We hit 513 today. We may drop below 500. We may see this back in the 480s. That may happen. This may be the start of a long-term downtrend for the next 6 months, maybe even 8 months to a year. But with that being said, if you invest little by little over time and average down on your position, you'll eventually get enough shares or invest enough money, whatever you're looking to do, to get into a position where you're looking strong for the long term. So when this does reverse and does flip back up to the upside, you're in a better position for yourself. VOO tracks the overall S&P 500, so it's the best 500 stocks. This is Vanguard's fund. Same thing with VOOG, which is a Vanguard growth ETF, tracking a lot of our top growth names and mainly tech plays. Again, this is fell from 429 down to 376 area. This could hit back down to around 340. We're basically back to where we were back in June or July of 2024, but in the grand scheme of things, this is such a minor pullback that looking ahead, this is just another dip in the road. So with that being said, taking a look at VOO and VUG, I think that these are both great opportunities for you to invest in the long term. I think that you're getting a great deal on both of these names, and I think that right now you got to be able to diversify your portfolio and maybe jump away from some of those big name stocks like Nvidia, Apple, Microsoft. Even though that's what these invest into those stocks, but plenty of others. So when one stock has a bad day, you're taking VOO and VUG into your portfolio and saying, look, maybe Microsoft fell 10-15% today, but the overall VOO and VUG only fell a little bit because of the fact that there's so many other stocks to be able to hold the overall ETF up. So with that being said, VOO and VUG are my top plays to be adding on the dips for the next several weeks until we start to see a bottom on this overall pullback. These are both names that I think you should be investing into. Now, if you just invested or just started investing, or you're with a 401k employer or whatever it may be, you might have noticed your 2060, 2070, whatever retirement fund you're in, that, you know what, you're not getting the returns you're seeing or the returns you may be wanting from individual stocks. Well, instead of jumping ship to individual stocks, let's meet in the middle. Let's do something that's aggressive but not too aggressive. Let's invest into the overall market, meaning VOO and VUG are great opportunities that have better returns and a lower expense ratio, giving you a great opportunity. And no, this video isn't sponsored by any means. I'm not affiliated with Vanguard, but I think that they are great buying opportunities for the long term on these dips. And again, looking at the overall past several years, this is just a small dip in the road. We saw what happened during 2022 and into 2023. We had that massive pullback for several months where the stock market fell, and then we had a massive rally. We again could see that again, but this time you'll be better prepared because you're investing into VOO and you're investing into VUG, which gives you the opportunity to make that money in the long term, because eventually over time the stock market will bounce and you're going to start to see those gains, because some of the best days that we've seen overall in the stock market have happened after some of the biggest losses out there. So with that being said, take that into account when moving forward. Find out what is the best overall S&P 500 or growth fund tracker that you can find. For me, it's VOO, VUG, VTI. There's a lot of great names out there. But if you're looking to invest in the stock market, start it. Or if you've been continuing to add to these names, then congratulations to you. Stay away from those retirement accounts unless you're closer to retirement. Then I say go for it. Go for that 2050, 2060, 2070 target date retirement fund. But if you still have a long time before retirement, I think that you have to go into something more aggressive, and going into a name like VOO and VUG that are returning 12 to 14% over the past 10 years is a lot better of an option if you're in your 20s, 30s, and 40s than if you're looking to retire in the next couple years. Then I say go for that retirement fund. But at the end of the day, make sure you do your own due diligence and research before jumping into any positions. Guys, if you have any questions, comments, or concerns, drop them down below in the comments. Hit that subscribe button, like the video, and I'll see you guys next time.